What you can learn from The Intelligent Investor by Benjamin Graham. Graham, along with David Dodd, began teaching value investing as an investment approach at Columbia Business School in 1928. In 1949, Graham and Dodd published The Intelligent Investor. Here are some of the key concepts from the book. Mr. Market. Graham's favorite allegory was that of Mr. Market. This imaginary person, Mr. Market, turns up every day at the stockholder's office offering to buy or sell his shares at a different price. Sometimes the proposed prices make sense, but other times, the proposed prices are off the mark, given current economic realities. Individual investors have the power to accept or reject Mr. Market's offers on any given day, giving them a leg up over those who feel compelled to be invested at all times, regardless of the current valuation of securities. It is most advisable for an investor to concentrate on the real-life performance of their companies and the dividends they receive, rather than paying attention to the changing sentiments of Mr. Market as determining the value of the stocks. An investor is neither right nor wrong if others share the same sentiments as them, only facts and analysis can make them right. Value investing. Value investing is deriving the intrinsic value of a common stock independent of its market price. Analyzing a company's assets, earnings, and dividend payouts can help identify the intrinsic value of a stock, which can then be compared to its market price. If the intrinsic value is more than the market value, in other words, the stock is undervalued in the market, the investor should buy and hold until a mean reversion occurs. The mean reversion theory holds that over time, the market price and the intrinsic price will converge. At this point, the stock price will reflect its true value. Focus on stocks that are trading at 2/3 of their net value. Net is a value investing technique developed by Benjamin Graham in which a company is valued based solely on its net current assets. When an investor buys a stock at a price less than its intrinsic value, they are essentially purchasing it at a discount. Once the stock is actually trading at its intrinsic value, they should sell. Margin of safety. Graham also advocated for an investing approach that provides a margin of safety, or room for human error, for the investor. There are a couple of ways to accomplish this, but buying undervalued or out-of-favor stocks is the most important. The irrationality of investors, the inability to predict the future, and the fluctuations of the stock market can provide a margin of safety for investors. Investors can also achieve a margin of safety by diversifying their portfolios and purchasing stocks in companies with high dividend yields and low debt-to-equity ratios. This margin of safety is intended to mitigate the investor's losses in the event that a company goes bankrupt. The Benjamin Graham formula. Typically, Graham only purchased stocks that were trading at 2/3 of their net value, as a way of establishing his margin of safety. Net value is another value investing technique developed by Graham, where a company is valued based solely on its net current assets. The original Benjamin Graham formula for finding the intrinsic value of a stock was, with V representing the intrinsic value of the stock, EPS as the trailing 12-month earnings per share, 8.5 is the price-earnings ratio of a zero-growth company, and G is the company's long-term growth rate. Later, Graham revised his formula to include both a risk-free rate of 4.4%, the average yield of high-grade corporate bonds in 1962, and the current yield on AAA corporate bonds represented by the letter Y. Dividend stocks. Many of Graham's investment principles are timeless, they remain as relevant today as they were when he penned them. Graham criticized corporations for their obscure and irregular methods of financial reporting that made it difficult for investors to get an accurate picture of the health of a company. Graham would later write a book about how to interpret financial statements, from balance sheets and income and expense statements to financial ratios. Graham also advocated for companies paying dividends to their shareholders, rather than keeping all of their profits as retained earnings. Feel free to share with as many people as possible. Subscribe to the channel if you haven't. Be part of this ever-growing community and share your thoughts in the comments below.